all the regulation and because of the stress tests, right? And this regulation is passed shortly after the credit crisis. Banks have to keep more capital on their books today compared to any other time in their history. And they can't lend this money out or be aggressive with it, trading, getting into new markets because, everybody believes that's going to be the credit crisis all over again. So they only have two choices of what to do with this money. And those two choices are buying back loads of their stock or increasing their dividend. And the big banks are doing both. So Citigroup, big fan of for a long time in our portfolio. We're up nicely on it, pays a nice dividend. Bought back 10% of its stock over the past year. 10%. That's a huge number, guys. And you look at Wells Fargo bought back $20 billion worth of its stock in 2018. You have Bank of America said just recently they're going to buy back another $30 billion under a new buyback program. That's another 11% of their shares outstanding. So Citigroup bought back 10%. They expect to buy back another 10% over the next 18 months or so. JP Morgan said it's going to buy back another $30 billion as well worth of its stock in a new repurchase plan. Looking at all those companies I just mentioned, those big banks, every one of them increased their dividends easily by more than 10% over the past 12 months. Seems like they're increasing their dividend every quarter. Because they have all this money they have nothing to do with. And I have news for you. This trend is not going to change anytime soon. So I was just saying, for at least the past 2 years, you should own a large cap bank stock in your portfolio. I know a lot of people hate the large cap banks. I don't blame you, and I even hate them at what they did and the risk that they took and got bailed out with taxpayer money, and the fact that we didn't even receive any of that money that you made a ton of money on off of our money is pretty crazy. So I get it. They risk your capital, almost bankrupt the world, only to get bailed out. And what? They're even bigger today than they were back then. So if that pisses you off, which it should, you know what? Go vent on social media. Go hold up a sign in front of JP Morgan's headquarters saying how much banks suck, whatever you want to do. But if this is about money or making money, go buy a large cap bank. Now, for some reason, when you look at buybacks, this pisses so many people off. I don't get it. Guys like Dick Beauvais, he's been probably at 10 different companies in 9 years, if I had to guess. Pretty good banking analyst. Says that banks buying back so much stock is a horrible thing, since banks should not give away capital for stock. Not too sure what else he wants them to do with that money. But there's a lot of analysts out there say, well, if it wasn't for buybacks, not just banks in general, the S&P 500 would be much lower. Earnings would be much lower for so many of these companies. And when I hear that, it's ridiculous. I mean, it's funny. The number one driver of stocks is earnings growth. So by buying back their stock, these companies, they're automatically going to push earnings higher, even in the form of manipulation, legal manipulation. But this is what's driving the bank sector right now. And as an investor, what do you care about? The only thing you should care about is the stock price. You're investing in a stock to make money on it. You want to buy low and sell high. So buying back stock increases earnings at a time where their net interest margins are not really that strong, right? We're seeing lower interest rates. Again, I told you earlier, higher interest rates are usually good for banks. If we're raising rates or higher interest rates, they just have more spread on the interest they charge. It's a lot lower when those interest rates go lower. So this is offsetting that, which is great news. So you have them buying back their stock, which is increasing earnings, right? And then they're raising their dividends, which are all more than 3% on average. I think Citigroup's a little bit lower than that. And JP Morgan is over 3%. Bank of America is over 3%. It's around 3%, more than 3% around the average. But now by raising your dividend, you're making your stock incredibly appealing for investors who are seeking income, which is basically the entire planet, right? Or trillions of dollars, since interest rates are historically low across the world. Everybody's looking for yield. That's why you should have exposure to this sector. Not telling you to be overweight where you have to put all your money in it. No, but you should have some exposure to large banks who are providing growth through buybacks, right? Automatically, earnings growth. I mean, we're not talking about small buybacks here. They're buying back 10, 20% of their shares outstanding. That's the earnings profile. This is why I recommend Citigroup, because of this. And now they're seeing business trends pick up, consumer lending increase. They're seeing these trends pick up. Even if they don't, we're safe because they're buying back their stock at all times. or most of the time, which is providing that floor. When this thing comes down, if banks fall 10, 15%, how much stock these guys are going to buy if that happens? It's a nice safety net to have. But that's why you need to have exposure, again, not be overweight to the sector. Because that growth through buybacks and then income by raising their dividends seems like almost every quarter. And they're raising it significantly. They're buying back loads of stock. These trends are not going to stop anytime soon.